Hey everyone, it's Imran from Options Insight, back with your macro options spotlight. Okay, remember, like, subscribe, comment, make sure the algo sends this around. I want people to understand options. I want people not to be scared of options. All right, here we go. Strong close after a choppy week last week. So we did have Netflix come out, better earnings than expected. Google also rose, announcing that they were going to be laying off 12,000 people. And we have seen that trend as tech companies do cost cutting and right sizing, let's call it. Stocks are getting slightly rewarded by that. So that continues that theme. We also had OPEX rolling off, which may leave markets a bit more free to move now. We did think we were going to get stuck at 4,000. That didn't play out. The expiry ended up closer to 3,900, but then it did scream higher after expiry into the late session on Friday. And so we do think maybe there was some impact there of OPEX, but it was more keeping a lid on markets rather than making it stick to 4,000. Now, this week, direction is going to be determined by the likes of Microsoft and Tesla that are reporting. And then in commodities, we did see precious metals pausing a little bit after a quite amazing run that they've had so far this year. But then other commodities like oil, copper, uranium managed to churn out positive week again after looking like they wanted to correct, but they didn't manage to hold that. And they rallied back. And oil definitely looking more and more firm. We have heard that the SPR reserves that have been getting released onto the oil market had the first week there where they didn't do that. So, a lot of people in the oil market have been talking about the idea that when they stop offloading barrels onto the market, then we're going to see the real tightness of the market come back. And, that's something we need to look out for. But apparently they didn't release from the SPR last week. Looking at volatilities, equity vols did bounce a little bit firmer, as you can see on the S&P. They were basically a good sort of one and a half vols higher. If we look at carry, slightly positive carry now. You can see green across the board there. The only negative carry really coming from Nikkei and VIX, but VIX is a bit noisy there. But in terms of Nikkei, some decent moves coming from Bank of Japan. Everyone's speculating that Bank of Japan were going to change their policy, maybe raise that cap again. They didn't do it. And therefore, we saw some pretty wild swings in Nikkei, basically. Okay, moving on to earnings. So what are the big ones we're going to be paying attention to? If we look at, obviously, we mentioned we had Netflix last week. They beat, so that set the tone a little bit for tech. We will be looking for Microsoft. There's going to be a lot of focus on their recent investment in OpenAI, the company behind ChatGPT, and this whole AI revolution that's going on. So that's going to be interesting to see what goes on there. But they're talking about investing 10 billion into that. Tesla's obviously on Wednesday. Tesla have slashed prices pretty dramatically for their cars to try and spur demand. We may get some idea of how that's going. ASML on Wednesday as well. Big semiconductor name in Europe. That's going to give us a read on that industry, whether that oncoming recession that everyone's fearful of, whether that's denting demand for chips. And finally, there's loads of earnings, but I'm just highlighting the ones that I deem the most important. You've got Chevron on Friday, going to give us a read on the oil outlook, refining margins, which have obviously driven such a strong outperformance in that sector last year, which is up about 50%. So those are the ones to look for. In the macro space, much more quiet. We do have Q4 GDP and PCE inflation data out there, but the Fed is in blackout. We're going to get no chatter from Fed speakers this week. So we don't expect huge impact on the markets from those particular macro data points. Moving on. We did say last week that we like the idea of Nasdaq maybe having a catch-up move, given how much it's underperformed the Dow Jones. So here we've got the Qs and the diamonds, which are the ETFs of those two indices. You can see since September, the diamonds have massively outperformed, going up here in the orange line versus the candle chart, which is the Qs. Now there's a fair amount of congestion of resistance on the Qs. We've got this downtrend resistance coming not too far from here. We've got the 200-day moving average, and then we've got this horizontal resistance up here at 297. So if we do have a pop I could see us getting to the top of that zone at around 297. Maybe we break through it and have a charge, and then we could go to that 300, 305 area. But if tech earnings aren't a disaster and these stocks continue to get rewarded for cost cutting and things like that, the point is, it's no surprise that a recession's coming. We know a recession's coming. We've had the moves to reflect some of that back end of last year. Some of these tech names got destroyed. And the question is now, do they have a bit of a knee-jerk bounce here because they are a bit beaten up? Obviously, they've already started a leg higher, and it was quite an impulsive leg higher. Is there some more room to run here? I suspect there probably is, because no one seems to own these names. Everyone seems to be quite bearish these names. So I wonder if there's a pain trade to take these higher. And that's kind of what I'm looking for here over the next month. I think, gun to my head, is more likely we see some upside as the macro backdrop doesn't look quite as horrendous as we thought it did, as net liquidity might be turning up. The market's starting to sniff out a Goldilocks regime in the short term, where inflation is coming down pretty hard, but growth hasn't quite rolled over yet. So that's the idea. And if that does happen, then I do think these tech names could have a bit of a resurgence. So the question is, how do you play it? For me, I've been looking at my good old dashboard here on Nasdaq, and it's not that clear really, an obvious long trade here. The compass is obviously saying buy puts, because spot is relatively overbought in the range. Volatility is relatively cheap after getting hit. So that's saying mean reversion trade is to buy puts, but I don't think mean reversion is the right call here. I actually do think that we could get an extension to the rally. So when we're looking at that, I do think Vol's probably still got some downside, even though it's cheap. I think the VIX could break below 18 if we do rally. So I'm not in a rush to buy loads of Vol and pay loads of decay. We look at the volatility carry, it's positive, saying, you don't necessarily want to be paying too much decay here either. So what do? Right? The front end of the curve, you can see here, is in the low 20s, but it could steepen further. So I don't want to own too much outright Vol. So the question is, how do I get a trade on that is bullish, but kind of factors in what I'm seeing in the dashboard? So the idea is these digital call spreads, which are very tight call spreads. All right, catch you on the next one. Thanks a lot. I'll see you tomorrow.